Hello everyone, welcome back. This is part 5 of the video series for course 201, Building Statistical Arbitrage Trading Strategies in Bitcoin and Gold Futures Markets. Part 5 will explore market making strategy design in Bitcoin futures listed calendar spreads as opposed to the outright market making trading strategies we learned for Bitcoin in video series 1 through 3. Here in part 5, we will build on knowledge gained from part 4 in the gold market making calendar spread video series. Here we will reintroduce the standard 6 execution protocol and we will apply it to the Bitcoin forward curve. But first, let's take a look at the risk disclaimer. Everything discussed in this video and all content on marketmentor.io is for educational purposes only. I am not in any way providing financial advice or soliciting financial products. Trading futures markets carries significant risk and can result in loss of capital. So let's turn our attention to the book, and this is as mentioned in part 4 of the video series. We're looking at the second half of the book now. So here's chapter 7, where we're expanding the A plus B equals C methodology, working within the standard 6 and applying it to the Bitcoin futures complex down the curve. And let's take a look at the curve example from the book. At the time of the snapshot, we were looking at the M, N, Q, and U markets. That's the June, July, August, and September Bitcoin futures contract markets. And we see the prices plotted here at the time of the snapshot. Shows us a nice curve that's in contango. And to further build on our strategy here, A plus B equals C is applied to the calendar spread curve, which is the forward curve relative value, or the calendar spread forward curve. And we've plotted those calendar spreads MN, NQ, MQ, QU, MU, NU. We see the curve very nicely here on this graph, and we're gonna work our standard 6 strategy based on this forward curve and the A plus B equals C methodology, which we dig into here for Bitcoin on just further down in the chapter. And we have to remember here that Bitcoin is priced inversely. If we take a look back in the book to page 64, we remember that Bitcoin futures markets are priced unconventionally, where leg 2 minus leg 1 equals the spread. So what you do to leg 2, you do to the spread. If you are buying the spread, you are buying leg 2, selling leg 1. If you are selling the spread, you are selling leg 2, buying leg 1. And this is different from the standard convention that we know in gold, which is leg 1 minus leg 2 equals the spread, and what you do to the spread you do to leg 1, etc. But remember, for Bitcoin, have to ingrain this into our minds that it is leg 2 minus leg 1 equals the spread. So if we take a peek back at the intro to the A plus B equals C math for Bitcoin forward curves, then we see if we're long the spread, we are short M plus N. So we're long the MN calendar spread, the June-July spread, and then we're also long the NQ by being short N and long Q, and that equals long the MQ spread, which is short M plus Q, the July month's scratch. When you do the math here, minus M plus N plus minus N plus Q, you are left with minus M plus Q. Same is true for short the spread. If we're short the MN, we are plus M minus N, and if we are short the NQ, we are plus N minus Q, and we're the July month scratch here, and we're left short the MQ spread, which is plus M minus Q. That's short the June August Bitcoin listed calendar spread by being long June and short August. So we as we discovered in gold, we can apply the A plus B equals C methodology. If we know two of the variables, we can come up with a price for the third variable. In this case, we know the price for MN. Up here, we look at our curve. We know the price for MQ, so we can imply the price for NQ based on our understanding of how these calendar spreads are priced and utilizing the A plus B equals C methodology. And we just talk about that all the way down the curve, and we come up with NQ, NU, and QU based on the markets we have in our graph above. And of course, that's going to build into the standard six, which is where we deploy market making strategies throughout the calendar spread curve, and we incorporate a fourth month. In this diagram, that fourth month is September. So now we have markets for June, July, August, and September. If we look at A plus B equals C, we see MN plus NQ equals MQ, C plus new B equals double C, MQ, and QU equals MU, A plus new C equals double C, that's MN, and NU, the N scratched there for MU, and then our triangle, our new B and B market equals new C market, that's QU, NQ. The Q's are going to scratch there, and you're left with NU. And that's a good point for us to migrate towards our simulator and see this stuff as it's being priced in sim based on live order books. Um, so here we have the Bitcoin August outright, which is the front month at the time of this recording. We have the Bitcoin September outright, and we have the Bitcoin October outright. Using these outright markets, we have calendar spreads that correspond, and that's the Bitcoin AUG SEP spread, the Bitcoin SEP OX spread, the Bitcoin AUG OX spread. So that's QU, UV, QV, A plus B equals C. As we did in gold back in part 4, we're going to look at the best bid in the A market and the best bid in the B market to come up with our C market. And first we will rename, this will be A market, it's going to be QU, this will be our B market, and that's going to be UV, and this will be our C market. QV. So we look here, we have our A market, A plus B equals C, QU, UV, QV. We notice that the U's, the September contracts will scratch, and we're left with August and October. So let's now look at the best bids and the best offers in the A and B market to figure out how to price this C market. And we can put in some orders here in our execution window. So we have 98 bid in the A market, and I'm seeing the next best bid is at 47. So this is, as you can see, these Bitcoin calendar spread markets are much wider than gold, and this is because Bitcoin's a new futures market, and as discussed throughout the books and throughout the video series, when there's new markets, there's new opportunities, new trading venues, new trading opportunities. Applying these strategies to new futures markets is such a unique opportunity, especially for a product that is catching steam such as Bitcoin. So at the moment, and of course we are in simulator, so in the live market these spreads might be a bit tighter, but what we're noticing is no one's testing strategies, no one's really trying to figure this stuff out. So it looks like a good opportunity to me to really put some of this stuff in a simulator and try to figure out what's going on and how to potentially profit from this opportunity. And If we do the math on our best bids, 98 and 47, we're going to come up with 145. So I'm going to come to the C market. I'm going to bid 145. And really, I should stick to my principles. I should only bid a one lot there because there's only a one lot bid at 47 that I can scratch against. So if I do get filled at 145, if someone sells me 145 and I can't turn it for a profit, I can sell 47 in the B market and sell 98 in the A market to scratch this C market position. If we do the same thing on, and I'm going to drag these markets out a bit so that we can get a visual on, and this is a very wide. Okay, that's our best bid and best offer right there. That's the best view on it. If we pull the B market out, we see the best bid and the best offer, very widespread. So now the offer is going to be the best offer in the A market is 100. There's a one lot offer in the B market at 66. So I can offer 166 risk free because I can buy 66 in the B market and I can buy 100 in the A market to scratch this position. And so now you can see in this simulator, we are the best bid and the best offer in the Bitcoin listed calendar spread for August, October, and it's a very wide spread. So we're looking, and also recall that we remember the Bitcoin listed calendar spreads are reduced tick, so it's going to be $5 a tick and $25 a nickel price. So 145, we got one nickel, one, two, three, four nickel prices, so $100 to turn the spread at 165 to 145, and we're working at 166, so that would be $105. And this 166 order does have the possibility of filling at 170, so it could be $125 per round turn. And the reason this 166 could fill at 170 is discussed in detail in the book in the implied orders section. If this calendar spread market were to execute because a real order came into the October outright market and it was not filled against another order in October outright, the CME can sometimes route orders through the calendar spread as an implied. This is technically an implied order working the August and October outrights. So theoretically, and remember, if I'm selling the spread, I'm working to sell the back month. So I'm working an offer in October. So if a buyer came into the October outright market in Bitcoin and there was no liquidity there, let's say this book was blank, the CME could imply my offer in the calendar spread as an offer in the October outright, as long as there's an offer in August that can be bought to complete the spread. And as we know, in a reduced tick calendar spread, that cannot be synthetically filled in the outrights because the outright moves in increments of 5. So I could never sell 166s synthetically. The next best nickel price is 170. So that's what the implied order would work via the outrights. Just to run through that real quickly. It's not ultra important for what we're trying to understand here. What we're trying to understand here is how to match the best offers in the A and the B market to create an offer quote in the C market, and how to match the best bids in the A market and B market to create a bid quote in the C market, which I think we've done here. We see our best bids at 98 and 47, so we're bidding 145 because this order can be scratched by selling the B market at 47 and selling the A market at 98, and we're able to offer 166 because we see offers at 100 in the A market and offers at 66 in the B market. So if we were to get filled on this 166 offer, we could scratch by buying 66 and buying 100, so it's theoretically a risk-free position. And there's some reduced tick arbitrage here at play, as if this implied order does get filled at 170, I could immediately buy 66 and buy 100 in the B market and A market, relatively speaking, and that would provide me an immediate profit of $20 because I'd be buying 166 through the A and the B market because A plus B equals C, and I would have sold through the implied order at 170, and that's going to be 1, 2, 3, 4 reduced ticks $5 per reduced tick times 4 ticks equals plus $20. So there is some arbitrage at play here, despite the spread I'm already working to capture by offering 166 and bidding 145 were any other market participants looking to transact in this calendar spread against my resting liquidity, my market making liquidity. So the next point to move on to will be creating the standard 6 for gold or for Bitcoin, and we're going to do that now by bringing in the fourth contract on the curve. If we look back to the standard 6 in the book, we notice there's four contracts at play. There's the June, July, August, and then there's the September that we brought in. And we look at the forward curve. We're looking at June, July, August, September. Now for where we are on the simulator, since August is the front month, we have Aug, Sep, Oc. Now we have a decision to make. Do we bring in the November contract or do we bring in the December contract? So we can come to the CME Group website or whatever futures market venue you're going to be building your strategies on, and you can look at the volumes and see down the curve where is the next most liquid contract. So here's our August market, here's our September market, here's our October market that we currently have up in the simulator, Aug, Sep, Oc. And now what we're trying to do is figure out, do we want to build for November or do we want to build for December? So in this particular day, and another thing to mention, the open interest gets very light down the curve in Bitcoin, and this is just another example of the infancy of these markets. I mean, as we cover in depth, the 6 consecutive months plus two December contracts is a relatively new addition to the CME Bitcoin futures market complex. These additional contracts didn't come into play until the beginning of 2020. And that's why you're still seeing a very lightly traded back end of the curve on the open interest and on the estimated daily volume. But in this case, even though the volumes are so light, we do want to be market makers. We want to bring liquidity. That's what's going to spur more trading volume. Is if there's more orders to transact against, then traders feel more comfortable opening contracts up in these deferred months. And for the sake of it, we will build in December. December is a very important futures contract month. It marks the end of the year. Many systemic reasons to hedge in December for natural users and producers of the underlying asset. So we're going to build out our fourth contract in the Bitcoin December outright, and then the correlating listed spreads. So we'll bring Bitcoin December outright into play. Here's our December market, and now we need to come up here and add the corresponding calendar spreads for QZ, UZ, and VZ, and we're going to do that now. I will clone these. So this is going to be Bitcoin UZ. This is our new C market. Bitcoin Sep Dis, Sep Oc, Sep Nov, Sep Dis, and we will rename this properly. This is going to be the new C market, and that is UZ. Alright, now let's clone again. And bring in our double C market, which will be the Bitcoin Aug December spread, Aug Dis, QZ, Aug October, Aug November, Aug December. Here we are. Let's bring orders in. And let's rename the variable properly. This is going to be our double C market, DC, and it's going to be QZ. And now we can clone and bring in our new B market, which will be OCDIS VZ, OCNOV, OCDIS. Let's bring orders and rename the variable properly. New B. OCDIS. Okay, now we have our 4 Bitcoin outright futures markets, and we have our standard 6 execution protocol visualized here in a simulator for the Bitcoin calendar spread forward curve. And just to revisit briefly, we have the Bitcoin forward curve. We have 4 months listed in the book, and if you come down, we have the listed calendar spread forward curve that's showing all of the months, and that's what we're seeing here. And then we have our standard 6, and that's what we're looking at right now in the simulator. Outright markets, standard 6, and now we're going to become market makers in Bitcoin futures contracts down the curve. So the first thing we want to do is, again, go over our bids at best bids and best offers. We've already defined the C market as best bid at 145, so we are bidding 145. So we're going to bring some orders below into Bitcoin AUG October listed calendar spread. The best offer is now going to be, so it backed up a bit here, 101 and 66. It's 167, so I need to move my offer up to 167. You see 100 used to have a 1 lot offer there. It's now gone, so I have to adjust my orders in the C market. So 101 plus 66 is 167. I'm also going to fill in the order book and bring some markets, some transactable orders for other market participants. Next thing to do is to look and see if there's any liquidity in these December calendar spreads, and there's not much to lean against. So I'm looking in the DC market. No one's working any strategies in these markets, so it's pretty interesting to see that there's not even a bid being worked, and this is kind of this shows you that just no one's looking to make markets. And I guess what I can do very quickly is just look at the QZ market or the QX market, which is the BTC November. If there are some orders to lean against there, we might pull that up, but I think this is going to be equally empty. Let's see, OGNOV. There are 2 bids, no offers. So it's a similar story. I guess there's a little bit more action, but that's fine. It doesn't throw us off too much. We can show how to make markets regardless. So if we look at the A market and the new C market, we can make a market in the double C market. We see 101 and 250. That means we can offer 351 in the double C market. So I'm going to put a 1 lot offer at 351, and that's going to be leaning against this 1 lot offer at 250 in the new C market, and leaning against the 1 lot offer at 101 in the A market. So now we have an offer. We are the only offer in the simulator for the DC market. I'm going to offer above, and if I take a look at the best bid, there were no bids here to work again. I guess there's one at 150, so I can work at 248, but that's gonna that's just unfathomably wide. But that's where I can technically work, and I can work two lot there. I can bring some stuff into the book down here. But look, I mean, this is just an incredibly wide spread. Obviously, we're in a simulator, but there's potential that it is this wide even in a live market, or relatively wide to other more mature markets. Now, if we look in the new B market, see if there's any bids or offers here. I don't see any bids or offers in the new B market. I see an offer at 192, so we can look at our offers in the C market at 167 and look at the best offer in the new B market at 192, and we see that's 359. So I come up to yeah, and we already have a better offer at 351, which means, I mean, technically speaking, 351 minus the C market, I could bring an offer in to 184 in the new B market, and the only reason I might do this would be in anticipation of being able to um, sell both the C market and the new B market, and make a spread in the double C market that is this far off the best bid. Almost as a market maker, that's especially a primary market maker. That's kind of what you're in the business is doing, is providing liquidity at a desired spread. If someone wants to buy the DC spread, if someone wants to sell the DC spread, what's my spread have to be to assume that type of risk? So um, we can bring some orders in like that, but there are no other resting bids except if we go down to 80. So 145 and 80 is going to give us 225. I can bid 225. I think that's going to be a worse bid than what I already have. Yeah, I have 248 bid here, based on the left and right side. So you can see, and then I can bring an offer into the new C market. So we can do our triangle, our new B plus B market equals new C market. So I have offers at 66 and 184, and that's going to allow me to bring an offer in at 250 in the new C market, which interestingly there is an offer there. Someone else is already working that, and I'm going to offer that as well. And then on the bid side, it's just going to be tough to bring an order into the book, as there's nothing in the new B market until 80, and that's just going to be such a wide spread because that's 127 in the new C market. So you have to come all the way down to 127, and there's actually a bid at 150 that I believe we're already working against that bid in the um, in the double C market. So this just shows you kind of how, as these markets develop, you could have the potential to be some of the primary market makers down the curve in these outright markets. So we're going to explore another way to define these spreads a bit better, and to do so, we're going to come back to the outright markets, and we're going to create these spreads synthetically and see what the market is giving us synthetically in the active outright markets. So we already have built the BTC QU spread. Let's find it here and launch. So we have the QU spread, and we're going to bid 95s, and we're going to offer 105s, and although we could offer 100s, so we're going to offer 100s, and then we're going to also want to, and I might edit this for simplicity's sake. I might edit this spread and make it quote two ways, so that we are saving screen space with these execution portals. I'm going to have to put an order quantity in there. Bid 90s, let's offer 100s. So now we see we're populating the books in the outright markets, and then we can build our UV spread, and I'll make this quote both legs, and then we can launch the UV spread, and we're going to work this market at 45 bid, and we're going to offer at 60. We're going to offer at 70. 45 at 70 for this spread. Let's move the December out right over. Try to be conservative with our screen space. We have one last AEP to pull up, and it's going to be the December market. We're going to look for BTC. Let's see what we should build here. We should build the QZ calendar. The QZ AEP for BTC. So BTC QZ leg 1, leg 2, and we will do BTC Dece, BTC August, and looks good. So that's now launched that spread, the QZ leg 1, leg 2, and we will bid and offer this thing. Let's try to join at 305, maybe 300. 305 looks about right, and we can offer at 340. It looks like there's some implied activity there. So if we look at our orders in December, BTC December, and we're also working these orders in August as well. If we move these around, you can look at the offer in the August market as I move my bid, and you see how it's tightening. It's tightening up to closer to the best of book. So I'm going to work this spread at 310, and I'm going to work the offer at 335, and that's going to allow me to get a better feel of where I should be working bids and offers in the double C market. Because that market is just so wide. Let's try to minimize that. So if I'm gonna work synthetically to create the double C market in December, and let me just take a peek. This might be just a bit too aggressive. Maybe we should go 305. Alright, so if I'm going to bid this thing at 305 in the outright markets, just based on where the best bid and best offer is in the Dece outright markets, I can come into the calendar spread and also make a market at 305 because I'm bidding it synthetically, and I'm offering it at 335 synthetically, so I can come into the spread market and offer it synthetically. And if you remember, we talk about A plus B equals C. If I know two variables, I can come up with a price for the third. I can take my 335 offer in the double C market and subtract it from my 101 offer in the A market, and I get 234 in the new C market. So if I'm going to offer 335s, I'm theoretically offering 101 and 234. So I might as well come into the new C market and offer 234. And then I can do the same thing on the bid. I can take my 305 bid and I can work it against that 98 bid in the A market, and I come up with 207. And since if I'm going to bid 305, I'm theoretically bidding 98 and 207, so I might as well bid 207 anyway, as it is. And now I'm starting to build out a book and build out a bid and an offer. And as market participants want to transact here, I have reasons to be offering 234 and reasons to bid 207, and that's a pretty good spread to be making if there's some back and forth action. As a market maker, that's really what we're seeking to do, is turn our spreads, turn our orders over and over as many times as we can throughout a trading session. So I think, and also I can come into the new B market, and I can do the same type of math here as the double C. If I'm bidding 305, I can back that out of my C market at 145 and come up with 160 as a bid that I have a reason to work in. The new B market, so I'm technically already bidding it. I'm bidding 305s, which is bidding 145s and 160s in the C market and the new B market. And now I can relay this triangle again. So I got 160 in the new B and 47 in the B market, which is 207 in the new C market, and you see that's where my bid is at in the new C market. So my new C market bid at 207 is also theoretically bidding 47 in the B market and 160 in the new B market, which which you can see is where my bids are here. So now now if we take a look at this Bitcoin complex, we have bids and offers in the BTC August outright market, bids and offers in the September outright market, bids and offers in October, bids and offers all the way down the curve into December that market participants can transact with, and in the listed calendar spreads, we can bring some offers and some bids into the A market. We've already we can bring some offers and some bids into the B market and join the books here. And we've already brought in some liquidity to the C market based on our arithmetic A plus B equals C, and we've brought liquidity into the new B market on the best. We are the best bid and best offer there in simulator. In the double C market, we've brought liquidity in. We're the best bid and best offer there as well, simulator, and the same thing is true in the new C market. And we've triple checked our math across the board, and we're all lined up with everything. And the standard 6 execution protocol is allowing us to quote markets in 1, 2, 3, 4, 5, 6, 7, 8, 9 Bitcoin listed markets at the CME, and this even can be expanded into that November market that we skipped over. Same mathematics apply. So this has been an overview of how to become a market maker in one of the most exciting financial markets to come into play in a long time. And here we are building strategies to be on the best bid and the best offer down the curve in this financial product and in this derivatives market for Bitcoin. Thank you.